In today's tutorial, we will be talking about the triangle pattern. Now, the triangle pattern is a very powerful yet extremely simple formation on the Forex market, and right now we're going to learn how to use it and make profits with it. So here we've got a chart, a hypothetical chart that's kind of moving sideways, and if we draw a line above and below the chart, we'll see right away that the price is in a triangle formation. Where can it go from here next? Well, it can continue going in the triangle, and more often than not, that's exactly what happens. The price keeps progressing in the triangle. But then there's an issue. There's nowhere to go. The triangle ends. And that's exactly when this happens. The price shoots out. Now, the shootout can go up or down, depends on the situation. The outcome can be different and often, very often, unpredictable. However, the main core concept of the triangle is the fact that the amplitude of the price movements is decreasing. So you can kind of witness a consolidation in the market. And it's not a coincidence. It means that there's something happening in the world or in the traders' minds that is forcing them to slow down their trading and is increasing the level of uncertainty for this particular currency pair. And therefore, the market consolidates, and then, bam, all of a sudden something happens, a movement picks up, and it shoots out. So more often than not, it will happen exactly in this way. So the triangle will progress towards very close to its end, and then the market will exhibit an impulse, and the price will shoot out up or down. And that's exactly what we will be taking advantage of. So the triangle is also very good pattern because it actually gives you targets. So if you measure the base of the triangle and then you copy this measurement to the place where you think the price will shoot out, then an aggressive target is exactly the size of the base. But it is always recommended to go with the more conservative target, which is more reliable, half of the base. So if you measure half of the base from the point where you think the price will shoot out, that's where you should set your take profit. So let's look at the same situation, but when the price shoots out downwards. Here you'd also measure your base, copy it over there, and set your take profit at about half the distance of the base. So that's all good, but in reality, we don't know which way the price will shoot out. So what do we do? Do we buy or do we sell? Well, this is the beauty of trading a triangle. And that's why I love the triangle pattern so much, is because the price amplitude is narrowing down, and you know, or you're forecasting that with a very high probability there'll be an impulse, but you don't know which way. But on the Forex market, you can set stop orders, you can set pending orders, and that's exactly what you should do in this case. So instead of buying or selling and taking our chances with that, what we're going to do is we're going to set two pending orders, one buy stop order and one sell stop order. So whichever way the price goes, we're going to earn a profit. As long as there is an impulse, it doesn't matter whether it's upwards or downwards, we can earn a profit from that. And that is a massive advantage of technical analysis over fundamental, because in situations like this, you don't have to predict where the price will go, you just have to predict that it will go somewhere. And so we set these two orders, and the take profit of each of the orders is set at about half the base of the triangle. So that's exactly how you trade the triangle, and moreover, further in this course, you will see a live example from a real account where I do exactly that, and the triangle does shoot out and we do earn a profit. It's just mind-blowing how well this strategy works. So to sum up with the triangle, 3 main points. First of all, triangle means market consolidation, and it's one of those instruments of technical analysis that can actually picture the psychology of traders on the chart. So that is very powerful. So it combines technical analysis and sentiment analysis in one pattern. The second point is that the most likely exit out of a triangle is an impulse. Doesn't happen 100% of the time, but definitely happens more often than not. And the best part about this is you don't have to predict which way the market will go. All you have to do is set a buy stop and a sell stop order, and whichever way the market goes, you have a good chance of earning a profit. And finally, the triangle gives you a defined target. which is a very strong advantage of this pattern because it makes it straightforward and very easy to incorporate into your trading system. So, Fibonacci levels. So who is this person Fibonacci? Well, the real name of Fibonacci is actually Leonardo of Pisa. Fibonacci is kind of a nickname which he got, and most likely it meant a good son was born. He lived in the 13th century, and he's most famous for his Fibonacci sequence. So what is this Fibonacci sequence? Well, let's imagine a sequence of numbers which starts with the number 1. The second number is also 1. And then going forward, every next number is equal to the sum of the previous two. So the next number in this case would be a 2. The next number after that would be a 3, because 1 plus 2 is 3. The next number, 2 plus 3, is 5. The next number after that is an 8. I'll let you guess what the next number would be. That's right, the next number is 13. And so on, just keeps going forever. So what's so great about this Fibonacci sequence that makes it famous? Well, I'll show you right now. Let's quickly plot the number 1 and number 2 on a horizontal axis. Now what we're going to do is we're going to go through the sequence and take every number of the sequence and divide it by the previous number in the sequence and plot our answer on the same axis. So 1 divided by 1 is equal to 1. We've plotted it with an orange cross. Now let's divide 2 by 1 and we get 2. 3 divided by 2 is 1.5. 5 divided by 3 is 1.666. 8 divided by 5 is 1.6. 13 divided by 8 is 1.625. 21 divided by 13 is 1.615. So you kind of see where this is going. The crosses are getting closer and closer to one specific certain number. And that number is 1.6180339, and so on. And this number is known as the golden ratio, which is usually represented by the Greek letter phi. Phi is equal to approximately 1.618. Alright, so by now you're saying, Kirill, you're boring me with all this math. What's the purpose? What's the point? Well, let's have a look at some of the examples of where you can find the golden ratio that will probably blow your mind. First of all, if you measure the distance between the edge of your fingertips and your wrist, and then you measure the distance between your wrist and your elbow, it will be approximately 1.618. Go ahead, pause this video and give it a go. You'll be surprised at how accurate this is. Next, your fingers, actually, your phalanges on your fingers actually are in the same ratio as the Fibonacci numbers, so 2, 3, 5, 8. If you don't believe this picture, then here's an actual X-ray. Also, if you take any starfish and you measure its base and take it as a 1, then the distance between these two limbs will be 1.618. Now, if you want to get even to more depth, then we'll take the Fibonacci spiral, and you can read about it separately, but it's basically constructed of Fibonacci numbers. And you can find the Fibonacci spiral in many, many places in the world. For example, a lot of shells follow the same pattern as the Fibonacci spiral. Some galaxies, not all of them, but some spiral galaxies also follow the golden spiral pattern. So it kind of makes you wonder, how come the Fibonacci ratio can be seen in so many parts of nature? Let's take one more example. Let's take the human DNA. And if we measure its width and its length, then they will be exactly 21 angstrom and 34 angstrom, where angstrom is a unit of measurement for various little things. And if you recall, 21 and 34 are actually in our Fibonacci sequence. A coincidence? Maybe. But that's quite a lot of coincidences. And moreover, what's not a coincidence is that there have been experiments that have proven that figures and patterns following the Fibonacci ratio are much more appealing to the human eye than those which do not. So there definitely is some sort of mystery around the Fibonacci numbers, and nobody knows exactly why they're so common in nature and in the world. But what we can do is maybe take advantage of it, including in trading. So what traders and analysts did, well, they said if the Fibonacci numbers are in our DNA, and if they're more appealing to the human eye, and if they're all over nature, let's have a look and see if we can actually find them on Forex charts. So let's see what they found. If this is a just a random Forex chart, then very often you'll find that if you measure the distance of your trend, so the main part, the upward part, and then take it as 1 unit, and then you measure the distance that the price traveled during the retracement phase, you will often notice that the retracement is equal to 0.618 units. Now the best part is that if you divide 1 by the golden ratio, you will get 0.618. So this basically means that if you take your original trend as 1.618, then your retracement will be 1. So basically you see the golden ratio here. We'll just return back to 0.618, which is the inverted golden ratio. So how can you use this in your trading? Well, let's assume that we don't know any of that. We know that there's been a trend and we can see a retracement is starting. Well, now knowing about the golden ratio, we can predict that with a good chance, the retracement is actually going to go just exactly up to that 0.618 level. And that means we can enter into a sell order somewhere over there, and we can enter into a buy order once the retracement has completed, knowing that there's a high chance that from here on the trend will continue. So that's all theory, but let's have a look at a live example. This is the euro-dollar 4-hourly chart, which I took a snapshot of yesterday. As you can see here, we've got a downward trend first of all, and then we've got a bit of a retracement. So how about we go ahead and measure them? So the downward trend started up here, then the price went down a bit slower, went down fast, went down a bit, went actually up again, went down, and that was the end of the trend for now. Then the price started moving back up, went down a bit, and then went back up. So we're going to measure the distance between those 3 points, and those lines indicate where our measurements will be. So if we take the original trend, and we take it as 1 unit, then you will notice, and you can take a ruler and measure this on your screen if you like, or even open up the same chart and perform those measurements, you'll notice that the retracement was exactly 0.618. And I didn't have to look for this example. This was the first chart I opened up, euro-dollar 4-hourly time frame, January 2015. You can scroll through any chart you like, and sooner or later, actually sooner rather than later, you'll find one of these examples. So the golden ratio is very powerful, not only in nature, but also in our Forex trading, and we can use it to our advantage. And you will see examples of this in our live Forex trading further down in this course. By the way, if you're using MetaTrader 4, there's a very handy way to measure these retracements. If you go to Insert Fibonacci Retracement, you'll get a very handy tool which allows you to effortlessly measure Fibonacci retracements. On that note, we'll finish up today's tutorial. Please do leave a review if you haven't yet. I would really appreciate it, and I look forward to seeing you next time. Until then, happy trading. Let's